Good evening, dear students. Welcome to Ecal Academy. And today we will be doing practical questions on accounting ratio. It is purely CBSE board exam based questions. So if you practice this type of questions, the accounting ratio, the weightage is 5 marks. So you can easily score that 5 mark. So the first question yesterday we have solved. Again, I am solving the first question as a recapitulation. So let's solve that again. You have to read the question. It is written that the net profit after interest and tax of a company was rupees 1,20,000. Rate of income tax is 40%. The company has 10% debentures of rupees 1 lakh. Calculate interest coverage ratio. Whenever you solve accounting ratio, first of all, you have to write the formula for accounting ratio. The formula itself, you will get half mark in the board examination. So interest coverage ratio, here I am writing short form, is equal to net profit before interest and tax. Net profit before interest and tax, if you want, you can write the full form also, but examination may always you will be using full form only. So write it, net profit before net interest and tax, before interest and tax upon interest on long-term debt or the fixed financial charge. Another name is fixed financial charge, interest on long-term debt. Now it is given that the net profit after, so you can see the question, it is given net profit after interest on and tax. So we need to find out what is the net profit before interest and before tax. So let's solve that one by one. Here it is given that after interest and after tax, the company is having 1,20,000 profit. So like yesterday, I taught you that this is net profit after tax and interest. So that is 1,20,000. Always what we do, from the profit first we subtract, suppose our profit is 80,000. From the profit, we always pay first interest. That is fixed charge we have to pay. For example, 10,000. Now we are getting 70,000. And this 70,000, 50% may be tax. So 70,000 50% is 35,000. So net profit after taxes here we will get, that is 35,000. So this is given in the question as 1,20,000. Now from that, first what we will add, we have to go to net profit before charging interest and tax. First we will add back the tax, then we will add back the interest. Thus we get the net profit before interest and tax. So let's solve it again. So here you see, you can see the interest rate. What is the rate of interest? It is given in the question as 40%. You can see the question on the screen, 40%. So the given amount will be 60% because assume that total profit is 100%. From that you are making a payment of 40% as income tax. So what is the amount left? That is 60%. So children, let's write that if, here you will be writing working note. If 60% is 1,20,000, you need to find out how much 100%. That is net profit before tax. What about 100%? You can solve this. So net profit before tax, you will get net profit before tax. BT means net profit before tax. That is cross multiplication, always you have to. So 1,20,000 multiplied by 100 divided by 60. You will be getting 2 lakh rupees. If you solve, you can find out that. Now, 2 lakh is the net profit. Here it is given debenture. Debenture is our long-term debt and its interest. Interest on debenture is how much? That is 10%. So that also you can write here, interest on debenture. How much? 10% on 1 lakh. That you know that. That is how much? 10,000. Now, how to calculate? It is very easy to find out net profit before interest and tax. That is, net profit before before tax was 2 lakh and the interest is 10,000 upon what is the interest on long-term debt? That is 10,000. So you will solve this 2 lakh 10,000 divided by 10,000. So you will get the answer as 21 times. That means we will be easily able to cover our interest from our profit. So this interest coverage ratio is high. It is a very good indicator. So learn how to analyze. We have a total profit of 2 lakh. From that, easily we can pay off the interest. I hope you will be clear on this. Question number A. Now let's move into question number B. What to find out? Read the question. From the following information related to a company, calculate inventory turnover ratio. Opening inventory is rupees 20,000 and closing inventory is rupees 22,000. Purchase is 80,000. Wages 9,000. Wages means that is the direct expense. Opening inventory is given. Closing inventory, carriage outward, return outward is given. Then it is given that revenue from operation. After that, carriage inward also given. So rent is rupees 5,000. Let's see that. What is the formula for inventory turnover ratio? As usual, first of all, you will write inventory turnover ratio is equal to, for turnover ratio, I am writing TOR. T for turn, O for over, then ratio. Turnover ratio is equal to cost of CORFO, that is cost of revenue from operation. You should learn this language also. Upon average inventory. Average inventory ka formula also you should know that. Average inventory is equal to, so I'm going to just erase this, the previous one. Average inventory is equal to, what is the formula? Opening inventory plus closing inventory upon 2. So let's continue with that. Average inventory is equal to opening inventory plus closing inventory. I'm writing in short form, opening inventory plus closing inventory upon 2. Now, opening inventory is given in the question, you can see. So I'll highlight the C. Opening inventory is given and closing inventory also given. Now, let's solve it. What is the opening inventory? 20,000. And what is the closing inventory? That is 22,000 divided by 2. That is 42,000 divided by 2 is equal to 21,000. Average inventory easily you got it. Now let's find out the cost of revenue from operation. So what is the formula for cost of revenue from operation? Cost of revenue from operation is equal to, the formula is opening stock. So I will write opening inventory or opening stock. Opening inventory plus net purchases plus direct expenses. Direct expenses, you all know. What are direct expenses? Direct expenses means wages, then what will come? Carriage, inward, etc. So the direct expenses, after that, direct expenses minus closing stock. Okay, direct expenses minus closing stock or closing inventory. Here we have to use the language closing inventory. Let's solve it. Closing inventory. So we are supposed to take only direct expenses. Come back to the question. Let's see what are the things we have to consider. See the question. See here it is given opening inventory how much? 20,000. So let's take 20,000. Here again I am putting equation 20,000 plus. What is the net purchase? Net purchase means purchases minus purchase return. Purchase return you have to search. Yes, here it is given return outward. You can see that I circled the same. That is return outward. Return outward means we are purchasing, then we are sending it back. That is called a return outward, is another name for purchase return. Okay, so 80,000 minus 1,000. That is directly we can write 79,000. Then what is direct expense? You can see here wages are direct expenses. Then what is carriage outward is not a direct expense. That is a selling expense. So that is an indirect expense that we will not take. So I cancelled that. Then comes carriage inward. Carriage inward is a direct expense because while we purchase, we are purchasing the goods, we pay some expenses, carriage expense. That is also we have to add. So wages, we will add 9,000. Carriage inward, how much? 4,000. Then you can see that rent. Rent is an indirect expense we cannot take here. This is given only to confuse you people. Okay. Now we will be subtracting what? We can subtract our closing inventory. What is the amount of closing inventory? That is 22,000. So you will subtract closing inventory. 4,000 minus closing inventory is 22,000. So let's solve this. So 79 plus 9, 88, 88 plus 92, 92 minus 22, that is 70, 70 plus 9, 20, 90,000. Okay, you have to do use mental arithmetic, that will be more helpful to you. Okay, now coming back to this formula, we are back to formula. Let's see that average in cost of revenue from operation, we already find it out. That is 90,000 upon what is average inventory? 20,000. Now you have to solve this. So if you solve this, you will be getting 4 2s are 8. So 4.2, then 1. Then you are getting 4 2s are 8. 1. So 2, 9 times. You can divide it. 90,000 divided by 24. Okay. 4.29 times. This is turnover ratio. All the turnover ratio should be always mentioned in times. All the turnover ratios. Okay. There are 6 type of turnover ratios. All the turnover ratios should be mentioned in times. Turnover ratio always it should be high. If the turnover ratio is high, it means the firm is very efficient. Now, while you solve in the board examination, it will be a 3-marker question. Here for the formula, you are getting half mark. For average inventory, you are getting half mark. So now how many marks? It is of 1 mark. Cost of revenue from operation, 1 mark. Then after that, the entire this much, you are going to get 1 mark. I hope you are clear with whatever we discussed. Clear? This is also 1 mark. This it is 3-marker question. So interest coverage ratio and inventory turnover ratio. Sometimes here I am mentioning something extra also. Sometimes in the examination, they will be giving you inventory turnover ratio. Okay. And they will be asking you to find out average inventory period. How to find out average inventory period? What does it mean? In a year, within how many days or within how many weeks or months or days? Mostly it is days only. Within or how long, how far, how long? Now, what is the frequency of converting inventory into sales? That is the meaning of average inventory period. In a year, within how many days you will be converting your inventory into sales. That is average inventory period. Average inventory period is equal to, sorry, normally 365 calculate in days. 365 upon our average. 365 upon inventory turnover ratio. ITOR means inventory turnover ratio. If it is to be find out in month, then instead of 365, we can write 12 months. Now, 2024 is a leap year. So in 2025, if in the question paper it is mentioned as 2024, then you will have to take 366 days. So here what is that? You can see 365 I am taking on an average upon 4.29. So you will have to solve it. If you solve it, if I round it off into 5, you will get how much? 73, right? That means within 73 days, we are converting our inventory into sales. That is not that much a good indicator. Clear? It can be 10 times, 8 times, etc. is very good. If it cross 12 times, that means every month on an average, we have a sales. Okay, na? So these are. Now, we are moving ahead. I hope you are clear with average inventory period. This is also in the syllabus. So please learn this formula. If it is in month or day. Day to 365, month it will be 12 months. Moving into second question, let's see that. First of all, you will see what to find out. Here it is given, calculate the inventory turnover ratio. So how to calculate inventory turnover ratio? Just now we discussed the formula. Inventory turnover ratio is equal to, what is the formula? Inventory turnover ratio is equal to cost of revenue from operation. You can write CORFO, but examination you cannot write. You will write full form, cost of revenue from operation upon average inventory. Now, while teaching, we are using a short form, but examination may you cannot. Okay. Calculate the average inventory ratio for the years. Okay. 2 years you have to calculate. 2015-16 and 16-17. So first of all, you will write 2015-16. Then we will calculate for 2016-17. Okay. Now let's see that inventory on 31st March. So here it is given inventory on 31st March. That means 2015 ka this inventory is closing inventory. I hope you will be able to understand this thing, right? Now, now again 2016, this is closing inventory only. Now 2016-17 ke liye 2015-16 ka inventory will become opening inventory. That also I think you will be able to understand. Because this is inventory on 31. 2015-16 31st March ka inventory will for next year's opening inventory. Because 31st March means closing inventory. So 2016-17 ke we got opening and closing inventory. Now both year ka revenue from operation is directly given. So no need to find out. But revenue from operation we don't want. We need cost of revenue from operation. Now what is given? Here you can see that in the question it is given gross profit is 25% on cost of revenue from operation. Whatever is the cost of revenue from operation, uska 25% gross profit hai. But that's not given in the question. Okay. Now, again, in the year 2015-16, the inventory is increased by 2 lakh. जितना आपका स्टार्टिंग में था उससे 2 लाख रुपया एंड में द इन्वेंटरी हैज बीन इंक्रीज्ड. That means what will be the opening inventory? So here we can write opening inventory is equal to, we are discussing about 2015-16. So closing is 7 lakh. 2 lakh increased to become 7 lakh. So what will be the opening inventory? That is increased 2 lakh. So now you subtract 2 lakh. So you will be getting 5 lakh rupees. This one is clear. So what we can find out? We can find out average inventory. Average inventory is equal to, you will write formula only one time. That is opening inventory plus closing inventory divided by 2. So what is the opening inventory? Just now we had find it out. That is 5 lakh. 5 lakh plus. What is the closing inventory? Closing inventory you can see 7 lakh divided by 2. So that is how much? 12 lakh divided by 2, that will become 6 lakh. Hope this much is clear to you. Now the major thing, we need a cost of revenue from operation. So let's find out cost of revenue from operation. How to find out cost of revenue? Here it is given that, so I will divide this into 2. 2015-16. So first I will take for 2015-16. Then I will go to 2016-17. So revenue from operation is 50 lakh. Gross profit is 25% on cost of revenue from. Cost of revenue is not given. So the unknown figure will be considered as what? That will be considered as X, or you can take it as 100. In accountancy, normally we take it as 100. So you will write, suppose your cost of revenue from operation. Cost of revenue from, suppose cost of revenue from operation as 100. इसके ऊपर 25% ग्रोस प्रॉफिट. सो ग्रोस प्रॉफिट इज 25% का 100 के ऊपर 25% मीन्स 25. If you add cost plus gross profit, what is the formula? Sales, that is revenue from operation. So revenue from operation is equal to 125. That 125 is given in our question, that is 5 lakh rupees. I hope you are able to understand. Clear? Now, if 125% is 5 lakh, what we need? We need to find out 100%. 125% is given. What is the 125%? 125% is 5 lakh rupees, sorry, 50 lakh rupees. Then what is the 100%? Let's find out. So directly you can write cost of revenue from operation is equal to, directly you can write cost of revenue from operation is equal to your 100%, you need to find out. So here if you want, you can write it percentage and the amount. Okay. 125 percentage is given in the question, that is 50 lakhs. Then what about your cost of revenue? 100 percentage. That is equal to, you will write 50 lakhs, cross multiplication always, multiplied by 100, and that is given. We need to go to we are doing the cross multiplication. So always this is the cross multiplication. What to find out? Divided by 1,25,000. Now you have to solve it. Once you solve, what will you get? 425s are 525s are. Okay. Then you get 10 fives are, right? 10. 10 lakh into 4, that is 40 lakhs. 40 lakh is the cost of revenue from operation. Now, children, coming back to this, let's find out the average inventory turnover ratio. The same formula I'm taking here. The it is already written that 2015-16. Okay. So cost of revenue from operation is equal to 40 lakhs upon what is the average inventory? That is 6 lakh. So now you have to solve this. Once you solve this, you will be getting 0, 0 cut here. 6, 6 are 36, 4, then it goes on, goes on, goes on. Okay. 6.67 times. That is for 2015-16. Come back to the question and focus here. You need to find out cost of revenue from inventory turnover ratio for 2015-16 and 16-17. Now we will be finding for 16-17. All these procedures you have to repeat. So let's do it with the enthusiasm you have to do. Okay. So then only it will be very motivating. This is purely 3-marker question. For 2015-16, 1.5 mark. Whatever you do, ultimate answer you get, then the pure you will get 1.5 marks. Here method doesn't matter. Okay. But formula should be there. That's all. Now again we are moving ahead with the 2016-17. 2016-17. Now no need to write the formula. Directly we will be finding average inventory. Average inventory is equal to opening inventory plus closing inventory. You can see the question. The closing inventory is 17 lakh. Opening inventory is 7 lakh. I hope you are able to understand. So opening inventory 7 lakh. Last year's closing will be this year's opening. Plus 17 lakhs upon 2. That is 24 lakhs upon 2. That is 12 lakhs is the average inventory. Now what to find out? Now we have to find out for 2016 and 17, the gross profit ratio is given 25% only. So let's directly find out 2006. Now you no need to write all this method. You can write cost of revenue from operation is equal to, what is the cost of revenue from operation given? It is not given. So as usual, we will take revenue from operation. That is 75 lakhs. 75 lakhs multiplied by, you need to find out cost of revenue. Cost of revenue is not given. So you assume it as 100. Now the percentage of the gross profit is 25%. So here also revenue from operation will be 25%. So you add that, you will get 125. So 425s are, 525s are, 515s are, 15 are 60 lakhs. We got cost of revenue from operation also. So easily you can find out inventory turnover ratio is equal to 60 lakhs. That is, now no need to write the formula again, upon 12 lakhs. 12 fives are 60. So 5 times. Which year is better? Last year it was 6.67 times. Now it is 5 times. So the last years, that is 2015-16 is better. There the inventory is turned into sales in a increased frequency level. I hope you are able to understand this. You can go through. If any doubt, please clarify this. Learn the formula properly. Always write separately. Otherwise, CBSE answer sheet, it is very very much horizontal way, not in vertical way. So you can make two columns also. But if it make the presentation very untidy, then do it separately. First for 2015-16, then for 2016-17. So children, now let's solve one more question. If you wish, let's solve it. We are solving the questions which are on board level basis. So you need to practice rigorously. Constant practice will help you to score better. Always remember that. Let's solve question number 3. Here again it is there. Calculate revenue from operations. What is that? Sales. Revenue from operation means RFO. RFO means sales you need to find out from the following information. Here it is given current asset, then quick ratio is given, then current ratio is given, inventory turnover ratio. 3 type of ratios are given. Then one more information is given. Goods were sold at a profit of 25% on cost, not on revenue from operation, not on sales. On cost is given. Okay. Now let's try to solve it. How to find out? Quick ratio is given and current ratio is given. We know that quick ratio, what is the formula? Current ratio, what is the formula? So first we will write current ratio. You should know the formulas very clearly. Then only you will be able to answer fast. Current ratio is equal to what is the formula? Current asset upon current liabilities. Current asset upon current liabilities. Okay. Now, current ratio is given. What is current ratio? 2:1. So 2 upon 1 we can write 2:1 or 2 upon 1. Question make current asset is also given. What is current asset? 8 lakh rupees. But current liability is not given. Now I will write it as CL. Current liability is not given. Then how will you find out? Here you can see that current liability is equal to, it is directly you can see cross multiplication through that 8 lakh divided by 2, you will be getting 4 lakh rupees. So you find it out current liability, right? Now the same we can apply where? We can apply quick ratio. So what is the formula for quick ratio? Here I am writing, okay? Quick ratio is equal to, what is the formula? I am writing QR. Quick ratio is equal to quick asset or liquid asset. Quick asset means the asset which can be easily converted into cash. Quick asset upon current liability. We know quick ratio is given in the question, that is 1.5:1. That is 1.5 upon 1. Then after that, quick asset is not given, but we had to find it out current liabilities. How much? 4 lakh. Simply put up the value. So here we get quick asset is equal to 4 lakh into 1.5. Once you solve this, you will get how much? You will get 6 lakh rupees. I hope this is correct. You are able to understand. Right? Now you know that. So I hope this is clear up to this. First, the informations are given. 3 ratios are given in the question. Quick ratio, current ratio, and inventory turnover ratio. First of all, you got the current asset in the question. So you will think, yeah, current asset is definitely by applying the formula of current ratio, you can get current liabilities. From that, you will be applying the formula quick ratio or liquid ratio, or its third name is asset test ratio. The formula is that quick asset upon current liability, or quick asset ki jagah mein you can use, or the other name is liquid asset, right? Liquid asset upon current liability. You solve it, then you will get quick asset is equal to 6 lakh rupees. Now, what is the next thing you have to do? You know that always current quick asset is equal to, here I am writing separately. Here I will write. Current quick asset is equal to current asset minus inventory, always. Now, so you can take this inventory here, quick asset there. So inventory is equal to what is? Current asset minus quick asset. So this formula should be in your mind. This will not be giving, it is not given anywhere. From the quick asset formula, we always know that inventory is equal to current asset minus, sorry, Yes, current asset minus quick asset. So now we can take inventory is equal to, that inventory will be always average inventory if nothing is given in the question. So inventory is equal to current asset minus quick asset. So what is the current asset? We already know that 8 lakh rupees. What is the quick asset? We had to find it out. That is 6 lakh rupees. So our inventory is 2 lakh rupees. I hope this is clear to you. Now come back to the question. In question, you can see that. So we are going stepwise. How it is given in the question in the same flow, we are also moving. Okay. First, current asset, the current ratio, quick ratio. Then, by using these three, we got current liability and inventory. Now, we are going into the next level. That is, inventory turnover ratio is 6 times. Now, easily we can apply the formula. Inventory turnover ratio is equal to inventory turnover ratio is equal to, what is the formula? Just now we discussed in the above two question. That is cost of revenue from operation upon average inventory. Here, nothing is mentioned about opening inventory and closing inventory. So, whatever the inventory we find it out here, that will be our average inventory. But now we need to find out the cost of revenue from operation, right? So, cost of revenue from operation, how to get? Let's do that again. Cost of revenue from operation के लिए you can see that the goods were sold at a profit of 25% on cost. So before that, we need to find out cost of revenue from operation, because here it is given that we need to find out RFO, revenue from operation. We all know that revenue, sales is equal to cost minus loss or cost plus profit. So cost means here cost of revenue from operation. That we need to find out. Inventory turnover ratio is given in the question, that is 6 times. You can see that. So we will put the values. Simply apply the values in this formula. Cost of revenue from operation, we don't know. So leave it. But we know that average inventory is given as 2 lakh rupees. So now cost of revenue from operation is equal to, what is the formula? You will cross multiply. You will get 6 into 2 lakh. That is 12 lakh rupee is the cost of revenue from operation. Now come back to the question. Goods were sold at a profit of 25% on cost. Cost we got. Now easily you can find out your gross profit. That is called goods were sold at a profit means gross profit only. So we can find out here gross profit is equal to. Gross profit is equal to, let's bring out. Gross profit is equal to 25% on cost. Our cost is how much, children? 12 lakh rupees. So 12 lakh multiplied by 25 upon 100. If you solve this, you will be getting how much? It will be 3 lakh rupees. So revenue from operation or sales is equal to RFO is equal to, here I'm writing RFO. RFO means revenue from operation is equal to cost of revenue from operation. Now I'm writing CORFO. Normally we write that also the same in the class, plus gross profit. So your cost of revenue from operation is 12 lakh plus your gross profit is 3 lakh rupees. So your RFO is 15 lakh rupees. So this is only, this question itself is for 3 marks. So you should know the concept very well. Then only you will be able to solve it. Otherwise, it will be tough for you to solve this type of questions. I hope you are able to understand this and there is no doubt. If any doubt, you can go through. Just go through. If any doubt, you can refer the formulas. Well understanding of the concept. Intensity of the concept is must to solve accounting ratio. Because if you take last few years question paper, you can see current ratio, inventory turnover ratio, interest coverage ratio, every now and then these ratios are repeatedly coming. So all varieties of these ratios, all variety questions of these ratios, you have to prepare, it is must. Now let's go to, I hope this is very clear to you. Here we can see one more question in question B. So if it is a 4-marker question, 3 mark for this question and 1 mark for the question number B. The operating ratio of a company is 60%. State whether the purchase of goods costing rupees 20,000 will increase, decrease or not change the operating ratio. You have to mention that. Purchase of goods costing operating ratio of a company is 60%. This 60% will increase or it will decrease or no change. You have to clearly explain that. So how will you explain? We know that operating ratio is equal to what is the formula? Operating ratio is equal to, yes, operating ratio is equal to, what is the formula? 1 minute. Operating ratio is equal to the formula is that cost of goods sold or cost of revenue from operation plus operating expense upon revenue from operation. I am writing RFO for revenue from operation. This is our formula. Now, how to decide this purchase of goods costing? Nothing is mentioned. Purchase of goods costing, there is no name. So purely it is a cash, whatever it is, cash or credit, anyway, goods is coming. So cost of revenue from operation means what is the formula? You all know that cost of revenue means opening stock plus purchases minus closing stock. This is the opening cost of revenue from operation. That is cost of revenue from operation formula is opening stock plus purchases minus closing stock. Here only they mention the case as purchase of goods costing rupees 20,000. Now, when we purchase the goods, my purchases will increase by 20,000. Meanwhile, my closing stock also will increase by how much? 20,000, no doubt on that. So here comes 20,000. I will subtract also. And here I'm adding also. So ultimately, what is the effect? The effect is nil. That means there is no change in operating ratio if we purchase goods, whether it is cash or credit. I hope you are able to understand. The operating ratio, the formula is cost of revenue from operation plus operating expense. Now, operating expense, no need to take only. We are taking cost of revenue from operation. Cost of revenue operation means opening stock plus purchases minus closing stock. And here I am purchasing the goods. So my purchases will increase by 20,000. Same time, whatever I purchase, that will go to, because nothing is mentioned about sales. So it will automatically added into closing stock. So here if I am adding 20,000, that means I will have to subtract 20,000 also. So plus 20 minus 20, what is the effect? There is no change in my numerator, no change in my denominator. So the ratio will not change. The ratio itself will be 60% without any change. I hope you are able to understand this and clear with this explanation. That is question number B. Now again, there is one more question, 2 more questions. Let's move into that question, solve the question. It's very interesting. Next one. Let me to erase the space. Okay, let's focus again. Children, please be here, focus. Now see. It is given that first question, calculate total asset to debt ratio. Yesterday I taught you total asset to debt ratio. It's very easy to learn total asset upon debt. That is the proportion we want to know. Total asset upon debt. That is total asset to debt ratio. From the name itself, you have to learn the formula. So total asset to debt ratio is equal to, first of all, you will write the formula. The formula is total asset of TA, I am writing, upon debt. Here I am writing short form TA, otherwise, okay, let it full. Total asset upon debt only, okay? So we'll write full form. So, total asset upon debt. Okay. Now coming back to the question, let's see that we should always know total asset will be always equal to total liabilities. That is compulsory. Equity share capital at knowledge is compulsory. You should know total asset will be always equal to total liability. Equity share capital is given, long-term borrowings given, surplus, general reserve, current liabilities, long-term provision. All this you have to add. Then what will you get? You will get total liability because equity share capital is showing on the liability side, long-term borrowings, surplus, हमारे liability side में general reserve, current liability, long-term provision, everything will come on the total liabilities and capital side. So total liability will be always equal to total assets. And the debt is also given. What is the debt? Debt means long-term borrowings plus long-term provision, that you should know. First, let us find out debt. Debt is equal to long-term borrowings plus, you have to write the formula very clearly, okay? Long-term borrowings plus long-term provision. That is must, you should write formula. Whenever there is a long-term provision, it is a part of the debt only. So what is given here? 1,80,000 is our borrowings. And you can see here, I have circled it. That is 1,20,000. So the total will become 3 lakh rupees. That is our debt. I hope this is clear to you. Now we are moving ahead for our liabilities. Total, now you will write here. Total asset is equal to what is always? Total asset is equal to total liability. Because there is no item given to find out total asset. But liabilities के लिए सारे items दिया हुआ है. So what we will do? We will take liability only. No issue at all. Equity share capital 4 lakh. You will add all this, whatever is given there. 4 lakh plus long-term borrowings, 1,80,000 plus what is given? Surplus. Surplus means our profit. Profit is always to be shown in the reserves and surplus. General reserve is a part of the reserves and surplus. That also we will take. Then what is coming? Current liability. It is to be shown on the liability side under current liabilities. Long-term provision will be always shown on non-current liability. So you will be taking that also. Now add all this. So once you add, what will you get? 1,80,000 plus 1,20,000, 3 lakh. 3 lakh plus 4, 7. 7 plus 1, 8. 8 plus 1, I think it is 9 lakh children. I got 9 lakh rupees. Now let's see that how it will work. Here total asset is equal to total liability. So total liability I got 9 lakh rupees. So I will write total asset upon 9 lakh upon. That is 3 lakh rupees. Total asset to debt ratio is a solvency ratio. Solvency ratios are always to be expressed in pure ratio. So pure ratio means here it will be cancelled. 3 3s are 9. 3:1. You cannot write this in percentage. You cannot write this in the times. You will be writing only in pure ratio. Hope this much is clear to you all. You can just have a look. If there is no doubt, let's move into the question number B. Here you can see question B also. I'll highlight the question B. You can see question B here. Let's move into question B. The debt equity ratio of a company is 1:2. It is given. We also know that debt equity ratio is debt upon equity. State whether the issue of bonus share will increase or decrease or no change in the debt equity ratio. We have to think about that. Debt equity ratio. Whether the issue of bonus shares will increase, decrease, or not change the debt equity ratio. You have to take an example, imaginary example you can take and you can solve it. Okay. Now let's see that debt equity ratio. Let's take I will explain with an example. The same way you can solve in the examination also, because this will be a 1 marker question. So you need to solve it. Simply you write increase, decrease, you will get only half mark. That method also very important. Debt equity ratio is equal to, what is the formula? Debt equity ratio is equal to debt upon equity. So I'm writing D upon E. Debt means long-term debt. Okay. So here it is 1:2. So I'm taking it as 1 lakh. 1:2 means it can take any amount you can take. 10 lakh upon 20 lakh. That also you can take. I'm taking 1 lakh upon 2 lakh. My debt is 1 lakh. उसका double मेरे पास equity पड़ा है. Now what we are doing, issue of bonus shares. आप bonus share issue कर रहे हैं. When will you issue the bonus shares? When you don't want to pay the dividend in the cash form, because due to diversification, expansion, modernization, etc., firm is in need of fund. That time, what the firm will do? Firm will not distribute dividend in the form of cash. Instead of that, firm will be distributing or firm will be issuing bonus shares. In short, at the time of issue of bonus shares, there is no cash inflow, cash outflow. Okay. So let's understand this again. We know that equity. Equity means shareholders fund. Shareholders fund means what will come. We know that share capital. Okay. Reserves and surplus. I'm writing R and S. Okay. Otherwise, I'll write full form. Here I will write, I'll cancel this. Here I'm writing shareholders fund. Shareholders fund means owners fund, proprietors fund, equity. Here from the formula, I will write equity only. Okay, so it is easy to understand. Or you can write proprietors fund, or you can write owners fund. That is equal to always, what is the formula? Share capital plus reserves and surplus. Now children, please focus here. Reserves and surplus. Our profit will be always where? Our profit will be included in the or will be showing under reserves and surplus. So this profit may say what we will give. From the profit, we will be giving dividend. Now what we are doing? We are giving dividend, but equal to amount we are converting into what? We are converting into bonus share. So from here it comes into share capital portion. From the reserve, just there is a shifting of the place. That means first this much amount, dividend amount जो भी है वो reserves and surplus में. Now it is coming where into share capital. Then it will not going to affect our overall equity. Our equity will be same. I hope you are able to understand. That means the equity, there is no change. So our debt equity ratio will not change. No change in debt equity ratio. Because fund is transferred from one place to another place inside shareholders fund only. From reserves and surplus, it is added into share capital. So there is no change in the debt equity ratio. The question is that whether issue of bonus shares will increase, decrease, or not change. Answer is no change or not change. I hope the reason is also clear to you. Instead of distributing dividend in the form of cash, they are distributing bonus shares. So bonus share means it will be added with the share capital and subtracted from the reserves and surplus equal to the dividend amount. Amount which is equal to dividend. Now, I hope this question number 3, it contains 2 questions that both we solved. Question 2 we solved. Question 1 contains 2 good questions of board exam. So let's again move into the next question. Question number 4, it's very interesting actually. So let's solve it. Again, it comes into interest coverage ratio. See, how many times interest coverage ratio is repeatedly coming? The same question we have already solved. Here, slight changes are there. Still, let's solve it. I hope you will be interested to know this. Let's do that. Interest coverage ratio, you have to calculate. Net profit after tax. What is our formula? Let's write the formula. Interest coverage ratio is equal to. What is the formula? Interest coverage ratio is equal to net profit before interest and tax. NPBIT. In BST, we call it as EBIT, earning before interest and tax. Here you will have to understand net profit before interest and tax upon interest on long-term debt or fixed interest charge, जो भी आप लिख सकते हैं, or interest on long-term debt. So always you will write interest on debt. You will always write interest on long-term debt. We need to find out net profit before because question में after वाला दिया है. How to find out, children? Rate of income tax है. We know that first we will be add back what? Tax. उसके बाद क्या add back करेंगे? Interest. Okay. Both are very important. So let's do that. Income tax is 40%. Suppose if I take my total profit as 100%. From that I am giving 40% as income tax. So what is the remaining amount? Remaining amount will be 60%. That 60% is given in the question. I hope you are able to understand. Now again you can write the percentage and the amount. Percentage 60% is given in the question. How much? 1,20,000. What to find out? We need to find out 100%. So 100% is equal to how much? What we can do? We can do the cross multiplication. Let's do this. Cross multiplication, you should know that direct and indirect variation will a portion of mathematics. Okay. Net profit before tax. We will find out. Net profit before tax is equal to 1,20,000 multiplied by 100 divided by 60. We get the answer as 2 lakh rupees. You have to check, cut it and find out it. Okay. That is 2 lakh rupees. Now, what else is given in the question? 15% debenture. So I will erase all the marking. You can see that again in the question. You can see that 15% debenture. 12% mortgage loan भी है. दो चीज है. Two types of long-term debts are there. Which are there? 15% debenture also given and 12% mortgage loan also given. So first of all, let's find out interest on loan. Interest on long-term debt. Interest on long-term debt में let's see how to do. First one is what? 15% on 1 lakh. So you will find out 1 lakh into 15%. That will become how much? One lakh into 15%. 1 minute, children. Interest on debenture. Interest on debenture is equal to. That is 1 lakh into 15 by 100. How much it will become? You can find out. Okay. Once you find out, that will be 15,000. I hope you are clear with that. Okay. Now, again, 12% mortgage loan. So, interest on loan, 12% mortgage loan. You will find out. So, your 1 lakh into 12%. You solve it, you will get 12,000. So, what is your total interest? 27,000. Okay. Now, you will be going back. What to find out? Net profit before interest and tax. So, here you will write again, net profit before interest and tax is equal to net profit before interest and tax. Already we find it out for tax. So 2 lakh plus what is your interest? Interest amount is 27,000. So the total will be 2,27,000. This comes in our formula. You can see here that net profit before interest and tax is equal to, you can see. So 2,27,000 is it. We will take net profit before interest and tax. So what is the long-term interest on long-term debt? Just now we find it out, that is 27,000. You will have to solve this. If you solve this, what will be the answer? You can find out. It will be fine. So what will come? 8.4 times you will get. Okay. You can solve it. 227 divided by 27. So 8 sevens are 56. 8 2s are 16 plus y 21. 1. Then you are getting again 4 times. 4 sevens are 28. 10. Then again you get 2. Then put 0. It goes. So 8.4 times. Interest coverage ratio. Children, you know what is the ideal interest coverage ratio? 6 to 7 times. Here we got what is the answer? 8.4 times. So our interest coverage ratio is very good. That is above ideal ratio. Ideal ratio means it is good. If we have higher interest coverage ratio, that means we will be able to pay our interest on loan from our profit. Here only you can compare. What is our total profit? 2,27,000. From that easily we can pay 27,000. I hope this is clear to you, the interest coverage ratio. Again, tomorrow we will be continuing with a few more ratios. So children, let's have a recapitulation. We have done today interest coverage ratio, inventory turnover ratio. There we applied the formula of current ratio and quick ratio also in that question. Then some questions are like that. The ratio is given because of few item, whether there is an increase or decrease in the ratio, we want to know that. So that also we have done through this operating ratio and debt equity ratio. And here again, one more question is there. Let's solve that by tomorrow. So children, take care and focus on your learning process. That is much important because now hardly there is 1 month for board examination. Take care. Bye-bye.